For decades, sovereign debt has been the foundation of our modern financial system. Government bonds are the bedrock of global capital markets. They act as benchmarks for pricing risk. They're used as collateral in financial transactions. And they're seen as the ultimate safe asset for investors everywhere. But today, that foundation is cracking under immense pressure. Across both advanced and emerging economies, governments are entering what I can only describe as a sovereign debt siege. Over the past 20 years, public debt has First, after the global financial crisis, governments borrowed heavily to stabilize their economies. Then, the pandemic hit, triggering another massive wave of spending to protect households and businesses from collapse. The result was predictable. Debt levels skyrocketed. For a while, this all seemed manageable. Interest rates were at historic lows. Many governments could borrow for next to nothing. But that era is over. When inflation surged in the early 2020s, central banks reacted by raising interest rates at the fastest pace in decades. The financial environment changed almost overnight. And for governments drowning in debt, the consequences are profound. You see, unlike a company or a person, governments rarely pay off their debt. They just roll it over. When old bonds mature, they issue new ones to pay for them, pushing the obligation further into the future. When borrowing costs are low, this system works smoothly. But when interest rates rise, the whole thing becomes incredibly fragile. Refinancing gets more expensive, interest payments balloon, and governments have to spend more and more of their budget just to service their existing debt. This is where the siege really begins. As interest costs consume more revenue, there's less money available for everything else. Public investment, infrastructure, social programs, or even stabilizing the economy during a downturn. In emerging markets, this pressure can turn into a full-blown crisis very quickly. Many of these countries depend on foreign investors. When global financial conditions tighten, that capital can flee just as fast as it arrived. History is full of examples where rising borrowing costs and nervous investors triggered a sovereign debt crisis. But don't think advanced economies are immune. They might have deep capital markets and the ability to print their own currency, but they can't escape the fundamental math. When your debt grows faster than your economy, you're on an unsustainable path. Eventually, governments are left with only a few painful choices: raise taxes, cut spending, let inflation eat away at the debt's value, or just keep borrowing and hope that growth miraculously catches up. None of these options are easy. And because sovereign debt is so central to the financial system, the fallout doesn't stop with governments. Banks hold huge amounts of government bonds. Pension funds rely on them. Insurance companies need them to back their long-term liabilities. The entire global market uses government bond yields as the ultimate reference point for pricing risk. So when sovereign debt markets come under pressure, the shockwaves ripple through the entire architecture of global finance. This is why sovereign debt is the second pillar of what I call the debt triad. The first pillar is corporate borrowing. The second, as we've just discussed, is government debt. And the third, which is perhaps the most politically sensitive, is household leverage. In the next video, we'll dive into the world of household debt and see how consumer balance sheets connect with the wider financial system. Because in today's world, these three forces, corporate leverage, government borrowing, and household debt, are deeply interconnected. Together, they form the architecture of modern leverage and the structural pressures shaping our financial world. If you want to keep exploring the machinery of modern finance, make sure to subscribe to the channel. And for deeper analysis and research on these topics, check out my Substack. Thanks for watching.